Welcome back to Good Morning Kenya. We do hope you are enjoying the show so far. My name is Jane Mumbo if you're just joining us, and we're just so glad you chose to continue being with us this morning. Remember, you can always interact with us through our social media platform. On Twitter, we are using hashtag Good Morning Kenya, as well as our official station handle at KBC Television and at KBC Channel 1. Our individual handles as well at Jane Mumbo is my handle across all social media platforms. My colleagues at Remanyara and at Ramaguko is how you can find them as well across all social media platforms. Now, so from matters to do with health, we now want to move along and go to matters to do with investments. And you know, they say investments know no gender. So regardless of whether you're a man or a woman or otherwise, investment knows no gender. You have all that you need to venture into this journey. But why is it that most people fear going into this journey, especially if you are employed? You are in that comfortable zone. You're sure you have some money coming at the end of the month. There in between, you are sure at the end of the month, lubrication of sorts, and you will be good. So why is it that most fear venturing into this journey of, this entrepreneurial journey, as well as choosing to invest? Well, that is the discussion that we are about to have. And to help me with this discussion here in studio, we have two fantastic guests. I'll start with the extreme left. She is Natasha Gichuki. She is the legal assistant for Saiton Asset Managers. Karibu sana.
Thanks.
Good to have you again.
Yeah, thanks for having me.
All right, and now to my immediate left, we have Victor Odendo. He is the head of Unitrust for Saiton Asset Managers as well. Karibu sana.
Thank you very much.
All right, maybe you could give us the social media handles for this asset managers group, so that people can be able to interact with you guys as well?
Well, as long as you look up Saiton on whatever forum you're at, you'll be able to find the relevant handle. Yeah.
All right.
So we're across all social media platforms.
As Saiton Investments as a whole?
Yes.
All right. So if you have any questions that you feel you need to direct to them on social media directly, you can always just look them up. You just type in Saiton, you'll be able to find the relevant handles, and you can be able to interact with them on social media. And for the purpose of the show, you can use hashtag Good Morning Kenya on Twitter. So let's just start by demystifying this whole myth about investments that, in order to invest, you need a lot of money. That is the biggest line you will hear from most people. Mbona uja invest sina pesa? Kwani how much do you need? A lot.
Well, thank you for having us this morning. Indeed, it's true. And if you look at historically, and if you look at especially from a gender perspective, and even from a gap age gap perspective, people have this notion that investments really requires a lot of money. And maybe these perceptions have been built over time in that traditionally, most of the people we more or less relate to and money came from a position whereby they have so much wealth. But no one has done the investigation to see how did they get into this position? Was it inherited? Did they build it over time? How long did it take? We come from a perspective whereby we have, let me call it, entrepreneurs coming up. We have issues of get-rich-quick schemes coming up. So they more or less cloud our judgment in terms of what an investment is. An investment is something that takes time, something that has to be nurtured, something that you have to plant a seed for you to enjoy it in future. So that is an investment. And if you look at the journey in Kenya, for example, and the investment products that have been coming up in the recent past, you realize that for purposes of financial inclusion, the entry level for investment has actually been brought down. If I look back 16, 17 years ago, a product like, say, for example, a unit trust, the first unit trust in Kenya you could get in by starting with a minimum of 1 million Kenya shillings. This has changed. Right now you have unit trust for as low as 200 Kenya shillings. If you look at what the government is doing with financial inclusion, Makiba is another instrumental product whereby you're telling people, come invest, doesn't have to be much, start from as low as 3,000, build. And it's a culture that we need to inculcate to everyone across the board, regardless of gender and age.
Okay, I think most people actually confuse what an investment is and, being an entrepreneur. Is there a difference as such, because you just mentioned an investment is something that takes time. It doesn't just happen overday, as opposed to, you can just decide to go into any kind of business, might not be considered as an investment, but you see the benefits immediately. Now, what is the difference between these two terminologies, entrepreneurship and investments as a whole? Maybe I can hear from you, Natasha.
Well, entrepreneurship is also a form of investment. So we have the traditional forms of investment, which they include the unit trust, such as the money market funds. You can also invest in real estate, but the entrepreneurship is just a form of business. So if you buy, for example, a whole bale of clothes from Dubai and come and sell it here, that's still an investment. It's still a way for you to get returns. So there's no distinction as such. It's just a manner in which you can invest your money. So what determines the level of investment is actually kind of the risk. So for entrepreneurship, there tends to be a higher risk because you're going into uncharted waters. Okay. So it's you for yourself based on what you have. For traditional investments, they tend to be more secure. So if you're looking at putting your money by chance in a money market fund, or something like Emakiba, where you'll get a certain rate every month and where the amount of money that you put in is guaranteed, it's just a safer form of investment.
All right. And now just back to the initial question I had actually asked Victor, this whole question of, I need a lot of money, this whole misconception about needing a lot of money to just venture into any sort of investment. I especially know we'll be celebrating Labor Day tomorrow, and year in, year out, there's always the debate of tuongezwe salary. Subject to the high cost of living, taxes here and there, taxes inapanda, mshahara iko tu bado pale pale, so I cannot go into investments. So what do you make of such?
Well, generally, I think you can start investment from any amount. So it doesn't, as Victor said, it doesn't have to be, you wait until you have the 1 million shillings for you to put it in a certain fund. So the investment can start at any age and can start with any amount. Because even your child saving the 20 shillings every week, that is still part of investment. Yeah. So I think we just need to broaden our horizons and broaden our understanding and research, make ourselves available of what's available in the market for investment. And then find out what the minimum is and just start. Because once you start, it's easy to continue.
Yeah. So it's just a change of mindset that we actually need as a people to be able to just, embrace this whole idea of, you don't have to quit your job today so that you can start investing. You can start investing while you are still employed. And let's just talk about, the different, you had mentioned there are two major divides when it comes to investments, traditional and alternative. Tell us a bit more about the traditional sort of investments.
Well, in terms of investment and what my colleague has mentioned, that traditionally we are used to the things we see and have been available in the market for long. And we call them traditional because you can easily walk into an institution and get them. For example, a bank deposit. You easily go to the bank and you can get the terms of the contract, the tenor of the contract, this is a bank. Let's start from there. So those are instruments that we've been used to as a market to channel our investments or our savings. Government treasury is a part of the traditional aspect of investment because they have been there for since the terminology of investment actually just started and government. They have been tested over and over and over. Okay. Now with the developments in the global market and the markets in general, you realize there are other ways that now are coming are now being clustered and are being evaluated to more or less mirror what's also happening in the traditional space. So because of sophistication, they're calling it alternatives. And alternative is nothing much. The traditional real estate, for example, now has been classified as an alternative channel of investment. But why is it called alternative? Is because as you go into it right now, there's some modicum of, let me call it, sophistication. It's not as easy as it used to be. Let's go buy a plot and that's it. We are going to make money eventually. But right now, there are so many other sophistications that are coming from issues relating to just registration, evaluation, channeling or sourcing of funds to pay for it. Who are the players in the same space? So you realize that it's a mix of totally different things. Another area people are looking at is, say, private equity. Right now has been put as an alternative. Private equity, you know, it's easy to look at Safaricom in the securities exchange. But if I look at, for example, this institution, KBC, how can we evaluate it away from what is market-driven? So that is the level of sophistication that is coming into the market, and everyone is looking at it as an alternative sort of investment. And the reason why it's alternative is because it generates a slightly higher return than the traditional markets.
So that actually alludes to the fact that the risk factors are different when it comes to traditional and alternative?
Yes.
Definitely.
So traditional have lesser risk, lesser returns, as opposed to alternative, the higher the risk, the higher the return. Now, when it comes to both, when you're trying to venture into either of them, I'm sure there's those things that cut across board because they're investments at the end of the day. Now, when you're looking to start any investment, what are some of the basics that you need to just make sure you have handled before you actually decide to take off with that biashara, that investment journey that you're looking to go into?
We get this question a lot, and we just need to go back and start from the basics. I am an individual. What is my profile in terms of risk? What is my profile in terms of return? What is my profile in terms of how long do I want to make this investment? Then what is my profile in terms of how fast can I liquidate this investment if something was to arise within this investment period? So that's where you start. First, assess yourself. Then once you assess yourself, then you look at what opportunities fit this profile. So I will say that based on my assessment, I've reviewed that this is who I am, this is where I want to go. Now, what alternatives are there to enable me achieve that target? So I look into the market will tell me, you have alternatives, you have traditional. Then I say, because of my low risk, why don't I try something very low risk? Let me just take my money, give the government, and wait for a return after that period of time. The next thing you'll say that I want a very, very high return. So there are various ways you can go through it. And as my colleague alluded, do I want to be an entrepreneur, take very, very extreme risks and live with the consequences? Or do I want a platform whereby I can channel my funds through an advisor, for example, come through Sight on Asset? What products do you have as Sight on Assets? Which of these products meet the profile that I've just created for myself? Then pursue those investments through an advisor.
All right.
Because that's the other thing that people also try and keep forgetting, that they are fully qualified advisors in the market who can help you through this journey.
All right. So if I've gotten you right, some of the areas that you need to make sure you have, your information, you need to assess the risk that is involved in whatever venture you're looking to go into. Number two, you need to look at the returns, and this is what you will be making from the biashara. Yes. The time that is involved in, before you start seeing benefits from the investment. All right, and liquidation. Now, when it comes to liquidation, is this being able to turn that asset into money, or there's more to it? Let me hear from you, Natasha.
With regards to liquidation, in the sense that it is used, because there are two various forms of liquidation.
Okay.
One is the winding up, which is, I'm sure wasn't what you intended, and the other is just how liquid an asset is, how easily you can get your money back. So for different assets have different degrees of liquidity. So such that some of these investments have different lock-in periods, they have different times within which you can access your money. So that's just another important thing to look at. So as you're considering your investment, you as a person, you know yourself, you know how much you can invest, and you know when you'd probably need that money.
All right.
So you should look at how long would it take you to reach the return that you'd expect, and whether or not you'd be able to access your money within that period.
All right. So depending on how fast, or regardless of the time that is involved, you should look at how fast or rather slow it will take for you to just turn that investment into money, can be able to sell it off and get your money back.
Yes.
All right. And when it comes to advisors, is it just people to just help you get the knowledge that you require about that investment that you're looking to go into?
Definitely, you know, and Natasha did mention, if today you decide that I would like to become a full entrepreneur, and what I'm going to pursue is I'll be importing clothes from Dubai and selling in Kenya, you're not the first one to go through that journey.
Yeah.
There are people who have gone through that journey. They have their fair share of successes and failures, and they can guide you through that journey. If alternatively you are looking at, this is an advisor within, let me call it the capital market, for example, we are many advisors who are registered and qualified by the regulator to help you also through that journey.
Okay.
Yes.
Now, for this category that is, you know, employed, you have a full-time job, you might argue you do not have all this time to do your research, so you end up just venturing into a business. Maybe it's because it's in line with what you do at work, but it's now your business, and you might not be a good business owner as opposed to, you know, selling the product or service that you're selling. Now, what are some of the mistakes that most people do as a result of, you know, arguing the fact that they're employed so that they're, you know, the mistakes are reflecting on the other end of the investment that they've chosen to go into?
So I think one of the main mistakes people make is just not doing enough research around it. Because everyone has the ability to do business. What depends is who does business well and who doesn't.
Yeah.
So you need to understand your market. You need to do appropriate research surrounding the area that you want to go into. You need to know how much, you need to know what kind of risks you're expecting, and what kind of capital that you'd need to enable this business to survive during the period through which it may not make money.
Yeah.
Because a lot of businesses don't make money in their first year.
So you need to have information that will keep you going through that period.
Yes.
You don't give in before you actually get to see the benefits of the investment that you're chosen to go into.
Yeah.
Now, you both work for the unit trust assets, unit trust for sanctioned asset managers. What does that entail?
Well, a unit trust is ideally a pool of savings from different investors. So ideally, what unit trusts do is try and pull capital from individual, retail, corporate, SMEs, whoever is within that spectrum of investors. And the idea about this is, you know, let the investor benefit more going through a pool than an individual, because as an individual you are limited in very, very many ways.
Yeah.
Number one, there's economies of scale when, for example, you pursue this in a pool. They say there's power in numbers.
Yes, they do.
Yeah. So a case in point is our unit trust, for example, our money market fund. You have a minimum of, say, 5,000 Kenya shillings. If you can pull 5,000 Kenya shillings from 20,000 retail investors, it gives us a pool whereby we can competitively give the pool a good return than you going alone with your 5,000 Kenya shillings to a bank, for example. They'll just look at you and say, okay, 5,000 Kenya shillings, no worries, we know you're going to take it the next day from your ATM. But if you give us the 5,000 Kenya shillings, and with the experience we've had with our unit trust in the last 12 months, whereby our average has been around 11%, you know, sharing that 11% with the whole pool gives value to you.
Yeah.
And that's what you're trying to push as a collective investment scheme. Partner with any collective investment scheme, pool your resources, get a return, you have liquidity, you can get your money back when you want. You have a platform whereby it's regulated, so it's not a Ponzi scheme whereby you're all running because there was a get-rich-quick scheme.
Yeah.
There's an advisor who will always work with you through that journey. There are options within the same unit trust. So if you want a low risk or a high risk, they give you a platform to enjoy that instrument, the way it's packaged, rather than just pursuing it as an individual.
And what are the risks that you actually make sure that, you know, anyone who's choosing to venture into this or join this unit trust needs to know beforehand before they actually put in their money? Let me hear from Natasha.
You can.
So generally, I think my key word for the day is just research, because we have very many different funds. So as a person investing in a unit trust, you'd go through even just any newspaper, find out which has the best return, find out what each minimum is before you select one. So generally for unit trust, the principal, that's the amount that you put in, is protected, but the rate of return is not guaranteed.
Yeah.
So,
so that is one thing you need to let people know.
Yeah, so one of the risks is just the rate of return can vary. But then the way to mitigate this is every day you can just get a newspaper, check and see how the fund that you've invested in is doing. Because most of them don't have strict lock-in periods. I think on average it's about 2 weeks or such. So once the lock-in period, that's the period within which you can't touch your money, is done, then you can move your money out. So as far as investments go, unit trust is fairly safe. It's a fairly low risk investment because you can always monitor how it's doing, and then you can always pull your money out. But then I think to notice that the rate of return is not guaranteed.
Just be sure that the rate of return is not always guaranteed, but at least this is information that is in the public domain before you try to get into any. Now, when it comes to venturing into any investment, you find that most people, the business collapsed because of the shortcomings of the person who is in that business. So let's just try and help our viewers better understand, and give them tips when it comes to any investment that you may choose to go into. And number one, it goes to the whole issue of discipline. Yes, you have a full-time job, so you find you are not giving this other investment the time and the discipline that it needs. What would you say towards this end?
Sorry?
When it comes to the whole question of discipline and investing, how would you relate the two?
Well, for you to invest, you have to be disciplined. You need to take into account that just because you get a certain amount of money doesn't mean you can use it all. Because investing is just saving up for a rainy day, saving up for your future, saving up so you give yourself more options in the future. So everybody just needs to learn to discipline themselves, set a budget for what are your necessities and what you need to also make your life enjoyable, but also take into account that you need to save a certain amount. Because the only thing that's assured in life is death and taxes. Your salary that you get monthly is not a guarantee, because anything could happen. Yeah. So it's always safer to just discipline yourself and have a nest egg somewhere.
Be disciplined. Anything you'd like to add into when it comes to the whole question of being disciplined in your investment journey?
Yes, she has correctly just said it, that discipline is key. And like you put it, you could be in employment and you're trying to pursue another business on the side. But what I will just add is whatever business you venture into, you must be sure that you have a very, very compelling business case and a compelling competitive advantage. And I think that's the challenge that you'll find that people who are trying to balance the two face, especially in the early years when especially they're trying to pick the business, because while you're working, you don't have sufficient time to pursue this. And you also ably put it that you can be an executor, but not the real owner who can deliver it. So go for people who can do that for you, support them with the resources they require, and they'll make it work for you.
All right. Now, when it comes to the whole question of, in order for a business to keep up, it needs money. And for most people, they get carried away when it comes to spending here and there. So when it comes to keeping costs at a minimum, what can you say towards this end, especially if you are fresh and new in this investment phase of your life? Keeping costs at a minimum, how would you advise people to go about that?
It's always prudent to just have a budget.
A budget just saves you the entire hustle.
A budget is essentially the art of controlling expenses. So if you can be disciplined enough to draft the budget, live within that budget, live within your means, then in a nutshell you have controlled your expenses. Because the people who are good at coming up with budgets, are they disciplined enough to execute that budget? Yes.
All right, so just a budget will save you so much. So if you are able to have a budget and try as much as possible to be disciplined enough to stick to it, because at the end of the day, an investment is about you take all the risk. You don't have an employer who will, shield you from unwanted, dents here and there financially. So be as disciplined as possible. Now, the other tip would maybe be diversifying where you choose to invest, especially when it comes to unit trusts. Does that actually go a long way in helping you just stay afloat, especially if you are new in this investment field? Let me hear from you, Victor.
Diversification, yes. Unit trust
can offer. Is it a good thing or a bad thing, first of all?
Number one, diversification is good. And if you look at history, and even all the books of finance and all theories of finance, the first thing they tell you, to mitigate risk, you start with diversification. So unit trust is one of the products you can use to diversify. So you can go through the pool and diversify through a unit trust, whereby you can go and say, I want a money market fund, or you can say, I want a more risky one, or a balanced fund, or an equity fund. So those three give you different, or all of them in different proportions. So that's one. So you can even have a unit trust on the side. Then you say, let me also put some money in a bank elsewhere for other use. So that's also a means of diversification. Yes.
So would you advise a client as has come to you for the first time they're looking to invest, would you actually advise them to diversify their assets, their money in terms of what they want to invest?
Yes, I agree with Victor totally in this aspect. Diversification is very important because it's just an added level of security on top of what is already offered by the level of investment that you choose. So there are many different options that you have in the market. So you should diversify. You'll get different rates of return. You'll get different risks.
All right. Now, when it comes to keeping the business afloat, you need to keep reinvesting. Now, after you have, put the books together, and you have this figure, the finances figured out, you have this money collected, how now do you go about determining which amount to reinvest after you have already know this is what I used to start the business, this is what I have made, this is what I want to do? How do you go about to just determine what you're going to reinvest back into the business?
I think it goes back to scalability. And if your business is not scalable, then you're not in the right business. So number one, if you're
what
going
does
for
scalability even mean in the first place?
Scalability means that your business can grow. It can get to the level.
Scale the heights.
Scale the heights.
Literally.
Become competitive, become larger. Get your own market share. Grow your market share, so to speak, or grow your market in terms of numbers. So for me to move from point A to B, I cannot just rely on my initial capital. I have to continue reinvesting in the business. But as you continue reinvesting in the business, you also remember you have to also pay yourself and whoever else is a source of capital for you. So when we start our journey, like as partners, we'll do everything, get some little money. We'll say, let's pay ourselves 10%, for example, or 20% of whatever profit. Let's reinvest the 80%. Until you get to a level, for example, whereby you can say our business has now matured. Whatever we make, we eat, because there's nowhere else you can take the business.
And then you'll be living the life.
Yes.
Now, when it comes to even this whole aspect of paying yourself, that is, I think, where most entrepreneurs and investors actually go wrong, because maybe this month your business was good, you made so much money, and you end up overspending, and then you're not sure of how the next month will be. So is it wise to work with a certain percentage when it comes to paying yourself off the profits, or just having like a fixed amount? What would you advise towards that end?
I'd advise that before you even start a business, you should have a business plan of how much you intend to make, what your costs are going to be, and what the difference would be, because that was what your profit would ideally be. But especially when you're starting, it may not be the best idea to have a fixed amount, because, as you said, you could do really, really well this month, but then maybe it wouldn't sustain till the end. So you paying yourself this fixed amount may get you to a point where you're unable to pay yourself, you're unable to run the business, because you've gotten to that point where you made less than you expected. So it would be better to have it based on a percentage, play it by ear, and look at it in such that you want your business to be alive in future. So not all your returns need to happen today.
Or have that longevity sort of mindset.
Yeah.
Yes.
All right. And always work with percentages. Don't just have, jilipa 150 grand every month and you make 200 grand from profit. That doesn't even make any business sense. Right now, when it comes to just advising the employed category to just venture out and just choose to invest in whatever capacity you're able, what would you say towards this end?
Well, there are more or less like 4 pillars to what I can term financial wellness, or we call it financial freedom.
All right.
And the 4 include saving, we're just putting money aside for a rainy day. There's budgeting, which we just discussed before, which is the art of controlling expenses. Then there's the monster in the room, what's called debt management, that is more or less a curse for most people. Then lastly is investing, which is making money work for you. So those are very critical. And if you are disciplined enough to ensure that every pillar is addressed, then you're on your way to your own success.
Letting the money work for you.
Yes.
What would you say towards this then, Natasha?
Well, I honestly agree with everything Victor put forward. Yeah, I agree with all the pillars he set out. Yeah, but still, I think it's always important to make sure you have a plan around it. And all of these things that Victor mentioned would be captured in a plan.
All right. Now, before we wind the conversation, we cannot, he just mentioned the whole issue of debt and debt management. You know, we are living in a time where our young people, with all this fintech, just taking control, you can be able to get a loan, quick loan from all these instant apps. Download the app, request, you're given a loan limit. You're like, oh my God, how did I even qualify for that? And you end up, you know, defaulting. Some end up defaulting, and, you know, it affects your ratings with the banks. Now, when it comes to debt, there's good debt and bad debt. When it comes to just, you know, getting into debt to start an investment, is that advisable to start off?
Well, it actually generally is not, because it depends on what kind of debt it is. And whether or not you can manage it, you can be able to pay it off. So it depends, to be honest, depends on the particular situation at hand. Because, for instance, like purchasing of a house is an investment. You can use it for rental income. But you wouldn't tell someone it's not advisable to take a loan to pay a mortgage on getting a house. Yeah. So you can't have a sweeping statement about whether or not it's good to have to take a debt to start your investment or to invest. It depends on the investment, and also depends on where the loan is coming from. Because it wouldn't be prudent to go to a Shylock who'd give you a rate of, let's say, 50%. Yeah, so it depends on whether you're getting the loan from and the kind of investment that it is.
Okay. Now, and
I think it's on the same. And you did mention in your opening statement that studies have actually have shown us that people get into debt not because they require debt, but out of between 60 to 75% of the people get into debt is because they qualify and they're available. And like you put it, every fintech company is coming up with a debt. You know, we offer debt in whatever platform. So as she has ably put it, that this debt that I'm picking, is it because I want to use it for something that is going to enable me first clear it out? Then I will stand somewhere and say, okay, from that debt, I have this house. Or from that debt, I made these investments, and this is the kind of return I have made. But you're not just taking debt for consumption. And that's what we call bad debt.
Bad debt.
Yes.
Money that cannot pay itself back at the end of the day.
Yes.
As opposed to a good debt, you can be able to lend money somewhere, invest it, and it will be able to pay itself back without you needing to go to dig deeper into your pockets to pay it. All right. Well, we do hope that, you know, as we celebrate Labor Day tomorrow, you're able to just know more when it comes to investing. Don't just sit there and be comfortable with employment. You'll get to an age where you cannot work anymore. You cannot pull an 8 to 5, and what will be your fallback plan? Well, we have been talking about, you know, just the whole issue of investing for this category that is employed. We are comfortable, and, you know, it's about time that you just venture out, start up any business that you feel you are able to. It doesn't matter. You don't need a lot of money, just as what we have had. You don't need to have a lot of money, tons of billions stacked away somewhere to just start off a business. Start with whatever you have. Unit trusts are there. You can be able to just go to them, get more information on all that you need to know when it comes to investing, and how you can be able to just make a coin or two from this. We have been talking about investment, especially targeting the employed category. As we celebrate Labor Day tomorrow, we do hope that you are better positioned and empowered to just venture out and start that business. Parting shots as we wind up?
Well, thank you for having us. And as I did mention that we are advisors licensed by CMA and RBA. You're welcome to pass by any of our branches and offices to get more advice in terms of the options we can offer you. And we will definitely assist you and work with you as you pursue your financial and investment objectives.
All right. And just a quick one. If somebody comes to you, you know, looking for advice, they want to go into this kind of business, but from what you can see from them, profiling them, you're able to know that this is not the best business that they are, you know, tailored to do. Are you able to figure that out and help redirect them?
Definitely.
Yeah?
Definitely.
All right.
That's part of our advisory role, and we'll definitely steer you. We'll tell you, in our opinion, this is probably the wrong approach. Then, you know, whether you take our option or you pursue a different one, that will be up to you.
All right.
But we'll definitely steer you.
So, Natasha?
Yes. Yeah, thank you very much for having us. So my parting shot would just be everyone should invest, and we should start investing as young as possible and as much as possible.
All right. Get your kids those piggy banks. Let them start saving from that early age. Inculcate that culture of saving in our children, because, you know, baby see, baby do. Show them how to save from such a young age. By the time they get into that employment age, you'll find that they might actually not need that employment to be able to just, you know, live out the rest of your life. Well, we have been speaking with Natasha Gichuki. She is the legal assistant for Cyton Asset Managers. Thank you so much, Natasha. And we also have Victor Odenda. He is the head of Unitrust for Cyton Asset Managers as well. Maybe you could remind us the social media handles so that our viewers can be able to just send through those questions if they have post the show.
On any social media platform that you're on, just key in Cyton at the search bar and you'll find one of our handles.
All right.
Yeah.
You'll be able to get the specific handle that you need for, you know, whatever kind of queries that you may be needing to have addressed. Well, thank you so much. We do hope you have actually enjoyed the discussion. We want to take a quick break, but we'll be right back with more of Good Morning Kenya. Remember, you can always talk to us using the hashtag Good Morning Kenya on Twitter. At KBC Channel 1 is our official station handle. My handle is at Jane Wambui, and my colleagues at Ramaguko and at Raymanyara is how you can find them across all social media platforms. Don't go anywhere. This is Good Morning Kenya.
The pressure to get a job for university graduates